All right. Low interest rates causing us to do all kinds of crazy things, such as predict the future returns of bonds for 10 to 15 years. I have no idea what bond returns are going to be over the next 10 to 15 years. Do I expect they will be lower than they were over the last 10 to 15 years? Yes, I do. But you know what's interesting about all this talk about low interest rates is everyone was talking about this in 2010 too, saying, oh, get out of bonds, rates are sure to go up. Well, guess what happened over the next 10 years? Not only did they not go up, they went down even more. So you really don't know what's going to happen with interest rates. Don't kid yourself that you can predict the future. If you think you can, start writing down what the future is going to hold. Okay. All right. A couple comments on Wade Pfau. Okay. Wade has taken a stance on some insurance-based investing products that I don't necessarily agree with. He has somehow become convinced that maybe it's not such a bad thing to have some whole life insurance and some annuities in your portfolio later in your career in order to, smooth things out during the withdrawal phase in retirement. I look at the data he looks at. I look at the papers he's published. I don't agree with all of the assumptions and thus don't agree with all of the conclusions, particularly with regards to the whole life insurance aspect of his message. In fact, at WCICon 21, which is now available as part of our Continuing Financial Education 2021 online course, I gave a whole talk on insurance-based investing options. Okay, everything from variable universal life and index universal life and index annuities and fixed annuities and deferred annuities and all kinds of annuities. Spent a whole hour talking about it. So if you really want the in-depth answer to this question, check out that talk. But let me go through some of the basics of annuities. Okay, the most commonly used and most common sense annuity, in my view, is a single premium immediate annuity. And what this is this is buying a pension from an insurance company. You give them a lump sum of money and they give you a certain amount of money every month from now until whenever you die. Whether you die at 65, whether you die at 103, they're on the hook to pay you every month, okay? Single premium immediate annuity. It can be a great way to spend your money in retirement. For example, if you know you don't want to leave any money to heirs, you don't want to leave anything to charity, you want to spend as much as you can, this is a pretty good way to do it, especially if you're buying one of these things in your 70s. It pays a lot more than the 4% withdrawal rate, right? So you can actually get more from your portfolio without having to worry about running out of money because you have this guarantee that it'll pay out until the day you die. And so it's totally reasonable, especially for somebody who barely has enough or doesn't quite have enough to really put a floor under their retirement spending and put, who knows, 10%, 25% of their portfolio into an immediate annuity at some point between age 65 and 75 or so. Totally reasonable thing to do. Another type of annuity is deferred income annuity. And this is probably best thought of as longevity insurance. Kind of gives you some permission to spend early in retirement, knowing that if you do live a long time, you got another source of income coming in. And this deferral period can be anywhere from 5 years, 10 years, even 30 years. So you could buy this thing at age 40. It doesn't start paying out until age 70. And the cool thing about it is because it doesn't pay you for years, when it does pay you, it pays this super high yield on your initial investment. Now, the insurance company got to use your money for 20 or 30 years, right, over the time period, so they should pay you well on it, but that's the way it works. So you might buy one of these, maybe you buy it at age 70 and it doesn't start paying out until age 90, but the yield on that can be pretty high. And that allows you to spend your 70s, spending maybe more of your nest egg than you otherwise would if you didn't know that you had this annuity backstopping you in the event that you really lived a long time. And so that's the theory behind longevity insurance or deferred income annuity. And I think that's a reasonable use for an annuity as well. However, when we start talking about replacing bonds or replacing CDs in your portfolio, what we're really talking about is a MYGA, a multi-year guaranteed annuity. This is a form of a fixed annuity. And what it is good for is you might get a higher yield on it than you do on a CD. That's not usually the case for 6-month, 1 year, maybe even 2-year CDs. But as you start getting out longer than that, you can actually earn more on these annuities than you can on a CDs in today's low yield environment. And it's not like some exciting return. Maybe you get 2% instead of 1.5%, or maybe you get 3.2% instead of 2.3%, right? So you do a little bit better. And it has one other cool feature. The other cool feature is that if you roll it into another annuity when that period is up, that term is up, you don't pay taxes on it, right? This tax is deferred essentially until you're done rolling it from one annuity to another. So that gives you a little bit higher yield too than the CD, which you would pay taxes on at ordinary income rates as it pays out. And so that's kind of a cool feature of annuity too. Another feature we occasionally see people use is a trick when people are dumping their whole life insurance that they still have a loss on. They might exchange it into a low-cost variable annuity. I think last time I looked, Fidelity had some of the lowest cost ones, and then let it grow back to basis, which growth is now all tax-free, and then surrender the annuity and move on with your life. It's just kind of a trick to make a little bit of lemonade out of lemons when you got suckered into buying a whole life insurance policy. But in general, remember that annuities are products made to be sold, not bought. They put lots of bells and whistles on them. And when you start looking at it, you realize that somebody selling it to you is making a pretty big commission, particularly on indexed annuities, right? It sounds like an index fund, so it must be good, right? No, the commissions are way higher than you would pay on a SPIA or even a DIA or a MIGA. You end up paying maybe even 8% commissions on those. Stay away from those. As a general rule, stay away from variable annuities. So you should have a very unique reason to get a variable annuity, and you need to make sure it's a very low-cost one with good investing options if you go down that route. But for the most part, you don't have to touch that stuff. And honestly, for the most part, bonds and CDs are still fine. Yes, you might be able to get a little more yield out of a MIGA, but chances are, if the rates end up going up, as a lot of people think they will at some point, I really have no idea. The bonds are going to be just fine again. They're nice and liquid. You don't have to deal with an insurance company. You don't have to deal with somebody trying to sell you more, or sell you a whole life insurance, that sort of stuff. So I would, as a general rule, I don't like mixing investing in insurance, but that's kind of the deal with annuities, places where you might want to look at them a little more carefully and things to be aware of.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.